Welcome back, Peter Schiff, and welcome back to a conversation that most people are not ready to have, not because the information is hidden, but because it is uncomfortable, inconvenient, and deeply threatening to the stories investors have been told for decades. What is unfolding in the silver market right now is not loud, it is not dramatic, and it is not being blasted across mainstream financial media with flashing banners and breaking news alerts. Instead, it is quiet, structural, and methodical. The kind of shift that only becomes obvious after it is already too late for the majority to act. Silver is moving into a phase that history has seen many times before, a phase where confidence erodes slowly at first, where distortions compound beneath the surface, and where price no longer reflects reality, not because reality has disappeared, but because it is being deliberately masked. To understand why silver matters at this moment, you have to step outside the narrow lens of short-term price charts and daily market commentary and look at the broader system that silver exists within. Governments around the world are drowning in debt, not the kind of debt that can be paid back through growth or productivity, but the kind that requires constant refinancing, monetary expansion, and currency debasement just to keep the illusion of stability alive. Central banks are trapped. They cannot raise interest rates high enough to truly fight inflation without detonating their own balance sheets and collapsing sovereign debt markets, and they cannot lower rates or print more money without further eroding the purchasing power of fiat currencies. This is not a temporary dilemma. It is a structural dead end. Silver sits at the intersection of this crisis in a way that very few assets do. It is both a monetary metal and an industrial metal. It is money with thousands of years of history. And it is a critical input for modern technology, energy infrastructure, electronics, and medical applications. This dual role creates a unique tension. On one hand, monetary demand for silver grows when confidence in paper currencies weakens. On the other hand, industrial demand grows as the world pushes toward electrification, renewable energy, and digital infrastructure. Yet despite these powerful demand drivers, silver's price has remained artificially subdued for years, leading many to dismiss it as a disappointing or irrelevant investment. That dismissal is precisely what makes this moment so dangerous and so potentially explosive. Peter Schiff has long warned that markets are not free in the way people assume. Prices are not always the result of organic supply and demand. They are often distorted by policy decisions, leverage, and intervention. In the case of silver, suppression has been an open secret among those who study the precious metals markets closely. Massive paper contracts, leverage futures, and derivative positions have allowed large institutions to create the appearance of abundant supply, even when physical silver is becoming increasingly difficult to source. This disconnect between paper silver and physical silver is not sustainable indefinitely. It has persisted only because confidence in the system that supports it has persisted. Once that confidence cracks, the repricing can be sudden and violent. The warning signs are everywhere, but they are subtle enough that they are easy to ignore. Governments continue to run record deficits during periods that are supposedly economic expansions. Central banks talk about fighting inflation while quietly tolerating it, redefining it, or blaming it on external factors rather than acknowledging its monetary roots. Real interest rates remain negative in many parts of the world, punishing savers and rewarding debtors. The purchasing power of currencies declines year after year, even when official statistics attempt to downplay the reality experienced by ordinary people. Food, energy, housing, healthcare, and education costs rise faster than wages, and the response is always more intervention, more spending, and more monetary distortion. Silver thrives in environments like this, not immediately, but eventually. Historically, silver has been one of the last assets to move, and when it does, it tends to move explosively. This pattern confuses investors who expect linear progress and predictable timelines. Silver does not gradually climb in neat, orderly steps. It spends long periods being ignored, ridiculed, and underestimated, and then it reasserts its monetary role in a way that shocks those who assumed it was irrelevant. This is not speculation. It is observable in history, from ancient monetary systems to modern fiat collapses. One of the most misunderstood aspects of silver is its relationship to gold. Many people view silver as merely a cheaper version of gold, a kind of consolation prize for those who cannot afford gold. This framing is not only incorrect, it is dangerous. Historically, the gold to silver ratio has fluctuated dramatically, often signaling periods of monetary stress. When confidence in currencies erodes, silver tends to outperform gold on a percentage basis because it starts from a more suppressed and undervalued position. Today's ratio remains far above historical norms, suggesting that silver is priced as if it were abundant and unimportant despite evidence to the contrary. The industrial demand story alone should give investors pause. Silver is essential for solar panels, electric vehicles, batteries, semiconductors, and countless electronic components. Unlike many industrial metals, silver is consumed in the process. It is not always economically recoverable once used, meaning it is effectively removed from above-ground supply. At the same time, mining production has struggled to keep pace. New silver discoveries are rare, mining costs are rising, and many silver mines are actually byproducts of other metal operations, limiting the ability to rapidly increase supply in response to higher prices. This creates a structural supply constraint that is incompatible with the assumption of endless availability implied by paper markets. Peter Schiff often emphasizes that inflation is not simply rising prices, but the expansion of the money supply. When governments finance spending through debt that is effectively monetized by central banks, they dilute the value of existing currency. This dilution does not show up immediately or evenly. It flows through asset markets, distorting valuations and creating bubbles in stocks, real estate, and speculative assets, while simultaneously eroding the real value of savings and wages. Precious metals, particularly silver, act as a release valve for this pressure. They absorb monetary excess over time, but only when investors recognize the reality they have been conditioned to ignore, the idea that fiat currencies are stable because governments say they are is one of the most dangerous assumptions in modern finance. Confidence is not enforced by law, it is earned and maintained through discipline. When discipline disappears, confidence eventually follows. History is filled with examples of currencies that were considered permanent until they were not. In each case, precious metals reasserted themselves as stores of value, not because they were perfect, but because they were independent of political promises and policy errors. What makes the current moment especially precarious is the scale of global debt. Never before have governments accumulated obligations of this magnitude relative to their economies. Never before have central banks been so deeply entangled in funding government spending. This is not a normal cycle. It is an experiment without a historical precedent at this scale. Silver is not just a hedge against inflation in this environment, it is a hedge against systemic failure, against the possibility that the tools policymakers rely on no longer work the way they expect. The suppression of silver prices has also had psychological consequences. Investors have been trained to view silver as dead money, something that disappoints while other assets soar. This conditioning keeps participation low, which in turn keeps prices subdued, reinforcing the narrative. But this dynamic depends entirely on the continuation of confidence in paper assets and central bank credibility. When that confidence falters, the shift in sentiment can be dramatic. Eats that were ignored suddenly become essential, and the scramble to acquire them exposes how little physical supply is actually available. Physical silver is not the same as digital claims, exchange-traded products, or futures contracts. In times of stress, the distinction matters. Counterparty risk, delivery risk, and liquidity risk become real concerns, not abstract concepts. Those who assume they own silver may discover they only owned a promise. This realization has historically been a catalyst for rapid repricing, as demand shifts from paper exposure to physical possession. The mainstream narrative often portrays precious metals investors as alarmists or relics of a bygone era. This caricature serves a purpose. It discourages serious analysis and keeps attention focused on assets that benefit from monetary expansion and financial engineering. Yet the same institutions that dismiss silver publicly often maintain their own exposure quietly. hedging against the very risks they tell others not to worry about. This asymmetry of information and behavior is not accidental. Silver's volatility is often cited as a reason to avoid it, but volatility is not inherently a negative trait. It is a reflection of uncertainty and imbalance. In a world where prices are increasingly managed and smoothed through intervention, volatility can be a sign of honesty, a signal that an asset is responding to real forces rather than artificial constraints. When silver eventually breaks free from suppression, that volatility will likely increase, not decrease, as the market attempts to reconcile years of distortion in a compressed time frame. This is not about predicting an exact date or price target. Silver does not move on a schedule that respects calendar years or quarterly earnings reports. It moves when confidence shifts, when narratives fail, and when the gap between perception and reality becomes too large to ignore. The current environment is ripe for such a shift. Inflation remains persistent, trust in institutions is eroding, geopolitical tensions are rising, and the tools used to maintain stability are losing their effectiveness. Peter Schiff's warnings are not about fear for fear's sake. They are about understanding incentives and consequences. Governments incentivize spending and debt. Central banks incentivize leverage and speculation. These incentives produce predictable outcomes, even if the timing is uncertain. Silver represents a counterweight to these forces, a form of insurance against policies that prioritize short-term stability over long-term sustainability. When the world finally begins to question the assumption that fiat currencies will always hold their value, the response will not be gradual or polite. It will be chaotic, emotional, and driven by a sudden need for certainty in an uncertain system. Silver, small and overlooked compared to other asset classes, will not be able to absorb that demand quietly. The repricing will not ask for permission or wait for consensus. It will reflect years of accumulated pressure released in a relatively short period. The most dangerous time to prepare is after the shift becomes obvious. By then, the narrative will have changed, prices will have moved, and access will be limited. The quiet nature of the current phase is what makes it so deceptive. Nothing appears broken enough to demand immediate action, yet everything is strained enough to make eventual rupture inevitable. Silver sits patiently in this tension, undervalued, not because it lacks importance, but because it exposes truths that the system would rather delay acknowledging. This discussion is not about chasing hype or predicting windfalls. It is about recognizing risk where others see normalcy and value where others see stagnation. Silver's role in the coming years will not be defined by headlines or short-term trading strategies, but by its ability to function when confidence in abstractions fades. Those who understand this are not early because they are lucky, but because they are willing to look beyond the surface and confront uncomfortable realities. As the global financial system continues to stretch itself thinner, relying on faith rather than fundamentals, the assets that require faith will become more fragile, and the assets that stand apart from faith will become more valuable. Silver has waited through long periods of neglect before, and history suggests it does not wait forever.